Across the global south, a quiet financial rebellion is taking shape. Right now, the world's majority is actively synchronizing their central banks onto new digital ledgers. Their specific goal is to bypass the absolute rule of the US dollar over global trade. For decades, African economies have operated inside a structural trap. Their financial survival is often dictated by distant economic shocks that local policymakers have absolutely no control over. When the Landshapir at the U.S. Federal Reserve, now managed by Kevin Warsh, decides to raise interest rates, borrowing costs spike worldwide. To prevent their local currencies from collapsing under the pressure of those higher U.S. yields, African central banks are forced to hike their own rates, which immediately chokes local growth. Add in geopolitical friction, like the American naval blockade in the Strait of Hormuz. Disruptions like this drive up global food and energy inflation, proving to developing nations exactly how easily dollar-denominated trade can be weaponized against them. If a nation is forced to conduct its daily commerce in a currency it cannot print or regulate, it remains permanently vulnerable to foreign policy decisions and economic collapse. This vulnerability is baked into the very architecture of international banking. It is a system built around something called the USD Detour, a legacy routing protocol that currently handles over 80. At that northern hub, the local currency is forced into a mandatory conversion. The Nigerian money is swapped into US dollars and then swapped again into Kenyan currency. Every single touch point takes a cut. Between correspondent banking charges and foreign exchange spreads, these unnecessary conversions cannibalize between 10 and 30% of the trade's total value. And the friction continues with the timeline. Because this money has to clear through multiple international ledgers, a simple neighboring trade takes 2 to 5 business days to actually settle. It is a slow, wealth-draining bottleneck, designed in a different century. That exact financial friction created the perfect vacuum for a grassroots rebellion. Facing staggering fees and week-long delays, everyday merchants didn't wait for a government solution. Last year, citizens moved an incredible $205 billion through alternative digital financial rails, completely bypassing the legacy banking system. The trigger for this mass exodus was simple survival. Take the Nigerian naira. After the currency lost more than 60% of its value against the dollar in a matter of months, local businesses needed a secure place to store their capital. They found that security in the blockchain. Today, 95% of active crypto users in these regions specifically request to be paid in dollar-pegged stablecoins instead of their own state-issued money. When citizens organically abandon fiat currency, traditional banking channels become obsolete. For the people running those central banks, that is a terrifying prospect. The anxiety is palpable at the highest levels of government. South African Reserve Bank Governor Lesetja Kganyago has been explicitly warning that the explosion of these private stablecoins is actively undermining African financial institutions. He is talking about a loss of monetary sovereignty. If a population entirely stops using the local currency, the central bank completely loses its ability to control inflation through interest rates. They effectively lose control over their own national economy. Faced with this growing irrelevance, the African Union launched an aggressive counteroffensive. They partnered with the IOTA Foundation to build ADAPT, a state-backed, unified blockchain ledger designed to reclaim control over the continent's digital trade. This is a highly coordinated, desperate battle by central banks to survive the rapid digital dollarization of their own nations. They are replacing their entire architecture to preserve their authority. The cornerstone of this defense strategy is the Pan-African Payment and Settlement System, or PAPSS. It is a centralized routing architecture built entirely to settle cross-border commerce without a single US dollar ever changing hands. Let's look at this split-screen comparison showing the old architecture on the left and the new digital rails on the right to understand exactly how much friction is being removed. Instead of sending capital up to New York, PAPSS utilizes a multilateral local currency net settlement mechanism. It connects local currencies directly. The buyer pays in their home fiat, and the seller instantly receives their own local fiat. Because there is no overseas hub, the old 5-day wait time collapses. The average PAPSS transaction clears in just 7 seconds. And when we look at the fee comparison chart, those cumulative 30% correspondent banking fees drop down to approximately 1%. By simply cutting out Western banking middlemen and allowing regional money to flow directly, this system is projected to inject $70 billion in annual trade right back into the African economy. This technological independence is running parallel to a major political awakening. Across West Africa, there is a massive, unified push to abandon the CFA franc, a fiat currency originally created by France in 1945. To sever legacy imperialist ties, the Economic Community of West African States plans to introduce a new common currency, the ECO, by 2027. The petrodollar still commands the bulk of global oil transactions today, so the US dollar isn't vanishing tomorrow. But with robust parallel digital rails successfully settling billions in daily trade, the absolute monopoly of the American greenback has officially been broken.